Hello learners. In this video lecture, we will be discussing about financial statements for a sole trader. Let's start with the meaning of sole trader. A sole trader is also known as a sole proprietorship or simply proprietorship business concern. Sole trader refers to a business started and run by only one individual. Financial statements prepared for a sole trader organization to report the financial results of business operations during an accounting period is called final accounts. Let's discuss about final accounts of a sole trader. Financial statements of a trading organization for an accounting period comprises of trading account, profit and loss account, and balance sheet. Trading account is prepared to ascertain gross profit or gross loss of the business operations during the accounting period. Profit and loss account is prepared to find out net profit or net loss of the business during the accounting period. And lastly, balance sheet reveals the financial position of the business on the last date of accounting period. Let's discuss about trading account. Trading account is taken as the first part of profit and loss account. It shows the amount of profit or loss on purchasing of goods and selling them, that is gross profit or gross loss. Gross profit is equal to net sales minus cost of goods sold. Now what is net sales? Net sales is equal to sales minus sales returns. And cost of goods sold is equal to opening stock plus net purchases minus closing stock plus direct expenses. In case cost of goods sold exceed the value of net sales, the result is gross loss. Trading account is generally prepared in T form for the accounting period. Trading account is a nominal account in nature. It is debited by the opening stock, net purchases, and all direct expenses. Net purchases is equal to total purchases minus purchase return. Direct expenses includes expenses directly incurred on purchase of goods or on creation of services. Direct expenses are carriage inwards, freight, wages, royalty on production, etc. On the other hand, trading account is credited by the net sales and closing stock. Again, net sales is equal to total sales minus sales returns. Closing stock is the value of inventory at the end of the accounting period. It is credited to trading account and shown as an asset in the balance sheet. The balance of trading account is gross loss or gross profit, which is transferred to P&L account for the same accounting period. Moving further, let's discuss balancing of trading account. When credit side is more than debit side, the balance is the gross profit. It is shown on the debit side of trading account and same is to be transferred to credit side of the P&L account. On the other hand, when debit side exceeds credit side, the balance is gross loss. It appears on credit side of trading account and same is to be transferred to debit side of the P&L account. Let's discuss the format of trading account. It starts with name of the firm, then trading account for the year ended on 31st December or 31st March for the given year. On the left side, we will find the expenses and it starts with opening stock, purchases less returns, wages, carriage, freight, dock charges, excise duty, octroi, import duty, fuel, power, etc., stores consumed, royalty on production basis, manufacturing expenses, and on the other hand, we can see sales less returns and closing stock. At the end, the balancing figure is our gross profit or gross loss. Gross profit is written on debit side and in case of gross loss, it is to be written on credit side. Moving on to the advantages of trading account, it gives information about gross margin, information about net purchases and net sales along with gross values and returns is available. Significant changes in the opening and closing inventory can be assessed. It helps in control over direct expenses through direct expense ratio. Trends of sales can be easily made. Moving on to the next account, that is profit and loss account. Profit and loss account is the most important part of financial statements of any business concern. It is a nominal account in nature. The first item in P&L account is the gross profit or loss as transferred from trading account. The gross profit will appear on credit side of the P&L account, and if gross loss is there, then it will be placed on the debit side of P&L account. Let's start with debit side of P&L account. Profit and loss account is debited by all indirect expenses incurred and losses suffered by the business during the accounting period. The indirect expenses include administration and office expenses such as salaries of office staff, office rent, rates, legal charges, audit fees, stationery expenses, telephone and postage expenses, insurance premium, and manager's remuneration, etc. Second one is selling and distribution expenses. These include salesman's commission, carriage outwards, depreciation, bad debts, repairs to delivery van, etc. Next one is financial expenses. It includes interest on loan, interest on capital, etc. And the last one is miscellaneous expenses such as donations, charity, loss by theft, etc. Moving on to credit side of P&L account, P&L account is credited by gross profit and indirect incomes earned by the business during the accounting period. Indirect incomes are those revenues that are earned by business from operations other than normal business operations. It includes income from investments, rent received, bad debts recovered, profit from sale of an asset, any rebate, etc. Let's discuss about balancing of P&L account. When credit side is more than debit side, the balance is net profit. It is shown on debit side of P&L account and same is to be transferred to the owner's capital account on the liability side of balance sheet. When debit side exceeds credit side, the balance is net loss. It appears on credit side of P&L account and same is to be transferred to the owner's capital account on the liability side of the balance sheet. Moving on to the format of P&L account, it starts with profit and loss account for the year ended 31st March or 31st December. On debit side, we can see gross loss, salaries, rent, commission, advertisements, bad debts, discount, and on right side we can see gross profit, interest received, commission received, and discount received. In case debit side is falling short, it is a case of net profit. And in case credit side is falling short, it is a case of net loss. Now, what is the difference between trading account and P&L account? The purpose of preparing trading account is to find gross profit or gross loss. And on the other hand, the purpose of making P&L account is to calculate net profit or net loss. In case of trading account, a balancing figure is transferred to P&L account, and in case of P&L account, balancing figure is transferred to balance sheet. Trading account includes direct expenses in earning sales revenue, and P&L account includes all indirect expenses. Now, trading account records sales revenue, and on the other hand, P&L account records other incomes and gains. Moving on to the significance of P&L account, it provides information of net profit or net loss for a particular period of time under consideration. It helps in comparison of profits of current year with previous year. It gives idea to plan the future course of action. And lastly, it helps in preparation of balance sheet. With the balance sheet of a sole trader. Balance sheet shows the financial position of the concern at the last date of the accounting period. It is also known as position statement. Like other financial statements, balance sheet is generally prepared in vertical form instead of statement form. An additional column is provided to present previous year's figures along with current year. Now, what do you mean by marshalling of balance sheet? Marshalling of balance sheet means sequence of assets and liabilities to be shown in the balance sheet. In case of sole proprietor, there are no statutory guidelines for sequence or order of assets and liabilities. But in case of joint stock companies, there is a specific pro forma prescribed by the Companies Act. There are two methods to prepare the balance sheet of a sole proprietor form of business. First one is Permanence Method. Assets and liabilities are shown in order of decreasing maturity period. On the asset side, fixed assets are shown on the top, followed by current assets. On the liabilities side, capital of the proprietor is shown on the top, followed by long-term liabilities and current liabilities. Now, let's have a look at the format of balance sheet of proprietorship business under Permanence Method. It starts with balance sheet as at 31st March or 31st December. On the left side, you can see there is liabilities, and on the right side, we can find assets. Now, liabilities starts with fixed liabilities, long-term liability, and current liabilities. And on the asset sides, fixed assets, intangible assets, current assets, and fictitious assets. Moving on to second method of preparing balance sheet, that is liquidity method. This method is reverse of permanence method. Under this method, assets and liabilities are shown in order of decreasing liquidity. On the asset side, current assets are shown on the top, followed by fixed assets. On the liabilities side, current liabilities are shown on the top, followed by long-term liabilities and proprietor's capital. Let's have a look at the format of balance sheet of proprietorship business under liquidity method. This is a horizontal form of balance sheet. Now, balance sheet as at 31st December or 31st March. On the liabilities side, you may find sundry creditors, bills payable, bank loans, outstanding expenses, incomes received in advance, loan on mortgages, reserves and surplus, and at the end, capital account. Moving on to the right side, that is asset side, it includes cash in hand, cash at bank, bills receivable, sundry debtors, advance payment, stock, investments, furniture and fittings, plant and machinery, land and buildings, trademark, copyrights, patents, and at the end, goodwill. Thank you.